All right, thank you very much for having me here. So the paper studies the asset pricing effects of inflation shocks, and there is one key empirical finding, and I think this finding is important. Core inflation shocks matter. They are all asset classes that they look at are negative core beta assets, and the key estimate in the paper is that 1 unit stronger beta exposure to core inflation is associated with 1 percentage point per annum risk premium increase, okay? And this is a very important estimate. Energy shocks are not significantly priced. So it's a very interesting paper, couldn't be more timely. The high core energy states of the world are high marginal utility states. Beware, what's going on with current inflation. Core inflation should give us a pause after we have seen that paper. And what is key about the identification of that magnitude in the paper is to look across asset classes. That's the novel aspect that gives you the magnitude of that premium. So the methodology is standard. They do a lot of robustness checks. If anything, I would ask them to do a little bit more to establish that fact even stronger. But the paper is very rich already. And then they have this qualitative model, New Keynesian model, to interpret some of the facts. So let us look at some of the main results. On the left-hand graph, you have core shock betas. On the right-hand side, you have energy. So you can see that all these betas estimated over the full sample are negative. And this gives you the estimate of the price of risk. That's the 1 percentage point per 1 unit of beta exposure. Okay? There is nothing interesting going on in energy. Here, the dispersion in betas across asset classes in terms of betas and expected returns gives you the identification of lambda. There could be more robustness on that, but in general, I think this is an economically robust finding. That finding is driven entirely by the pre-2000 sample. In fact, it is driven entirely by the great inflation episode in the data. And it's not there in the post-2000 sample or after great inflation. All these betas, core betas, are essentially zero. And it's not a bug of the paper, it's a feature. And we should just acknowledge that the identification of the price of risk comes from a particular episode. Now, given that, I think that the distinction between the core and energy that the paper is highlighting is somewhat artificial, or maybe a little bit too reduced form. So what I will talk about is an alternative view of inflation shocks. Okay, so this is the graph that we all know. It's headline inflation. 2 bars are 2 energy shocks. And here we have the sample, the break in the structural break in the dynamics. So when you superimpose core inflation and headline inflation, they essentially move in tandem until 2000. And the 2 big spikes in headline are followed with a little bit of a delay by spikes in core. The correlation between core and yeah, that's the problem that we saw yesterday already. The correlation between headline and core breaks down in 2000s, and well, unfortunately, we have little data, but it's back again today. So let's look again at the core, and let's superimpose the variation in energy prices. And what you can see is that, well, the 2 big episodes where core inflation was very high are preceded by 2 really prominent episodes in oil or energy dynamics. There was a lot of volatility in energy overall, but only in this pre-period did this propagate onto the core. later on, magically, probably through some smart policy, core inflation stabilized, and despite huge volatility in energy, there was no pass-through. So this you can see in impulse responses. The pass-through of energy shocks onto core was very significant in the pre-2000 period. And in fact, this graph is driven again by the 70s and 80s experience. There was very little pass-through of energy shocks onto core, or by the way, anything else in terms of like asset prices, long-term bonds, and so on, after 2000. The authors may argue that this impulse response is captured in their VAR, but the narrative of the paper is that energy shocks don't matter. They are not causal for premium, for the risk premium. And I think they do to the extent that they get propagated. So the origins of the great inflations were complex, but oil supply shocks, the negative oil supply shocks, were probably the most well-identified causal shocks driving inflation in that period and also being recessionary at the same time. They got amplified through policy mistakes and self-fulfilling expectations. So perhaps a useful way to think about shocks, different shocks in inflation, is to think about different types of persistencies that you get. So this graph is showing you expectations of inflation. The line is just current quarter. This is what we expect in the nowcast of inflation. Now, when you start looking at the term structure of these expectations, you start seeing different shocks playing a role. You can go to very long-term inflation expectations. And clearly, the pre-2000 episode is very different in that when an inflation shock hits, this shock is persistent. It stays around for a really long time. When inflation shock happens here, well, long-term inflation expectations don't adjust. There is short-run volatility that evaporates very quickly, okay? So this is very different. The two types of level type of shock and the kind of transitory shock are very different in terms of their asset pricing implications. So what are the two types of inflation that we are seeing in the previous graph? So a simple New Keynesian model, these models have issues, but in terms of generating two types of inflation, they are quite plausible. So suppose that you have a demand shock G, a cost push shock U that is driving the inflation, and the realistic feature here is that inflation expectations are sort of sticky. We talked about memory yesterday. These expectations can be backward-looking. So what would happen in this very simple, what happens in this very simple framework? So when you have a demand shock, it's positive demand shock drives output up, and there is a little bit of inflation. So growth is causal for inflation here, but it's good inflation. This inflation doesn't stick around for a very long time. If you get a cost push shock, what happens? This is the U shock. That's a bad shock. Inflation goes up, independent of anything happening in the real economy yet, but then this inflation becomes causal for output. So you have high inflation episode and decline in output at the same time, and that kind of slump becomes worse the more persistent inflation expectations become. So if inflation expectations are slowly adjusted, you will get this protracted inflation, persistent inflation, and long-lasting slump. Okay? And I think what the paper does is to tell us what is quantitatively the price of risk for this type of shock. Okay, that's the lambda core that they estimate, the 1 percentage point of beta exposure compensation. So the asset pricing implications of these types of shocks are well understood, but what what is true is that it's very hard to estimate the lambdas. And the fact that the authors use across assets variation allows them to give us that estimate. Okay, so that's very useful. So what happens in these standard models, if you combine easy preferences with a reduced form for the mechanism that mimics the effects of cost push shocks? Essentially what this means is that cost push shock is Granger causing output variation. What is going to happen is that you get this structure to risk premia. And the story about 70s is that there is high inflation uncertainty of this bad type. It will generate, increases in risk premia on bonds and stocks and positive co-movement. When this inflation uncertainty goes down, trend inflation uncertainty goes down, then the signs start switching because the real component becomes more dominant. Okay? So this will have implications for stock bond co-movement, for risk premia that we are observing on nominal bonds that are very low or negative, and so on. This is not exactly, though, so I think this is a realistic description of what happened and why we get identification from the stagflationary period and not from the later sample. But this is not exactly the story that the paper is telling. So I know the authors said that this is a simple model, but when you start looking at the particular restrictions, it's hard to figure out the immediate intuition. So the model has 3 shocks, exogenous, a markup shock, core energy supply shock, and energy demand shock. And let me look at some of the implications of what it does. So in the model, the energy of either type is essentially expansionary. So what is going to happen is that, well, the model gives you the following signs. And in the model, energy and shocks, either supply or demand, will generate pro-cyclical inflation. So the model's interpretation of the 1970s would be, we are faced with a negative supply shock, negative oil supply shock. Core consumption goes down, but also inflation goes down. So because of that shock, the model would generate deflation, but in the model there is an additional shock, exogenous to these forces, the markup shock that flips this sign, okay? Clearly, the energy shock was sort of pushing costs around and was in fact stagflationary. So the model doesn't generate that. This issue then propagates onto stock bond co-movement. Again, if you have a negative supply shocks, stocks are going to decline, but bonds are going to do well. So we should see a negative stock bond co-movement in the early part of the sample. That is not quite what is going on in the data. We know that stock bond co-movement was strongly positive in that episode. Okay? So the model, just through the energy part, energy supply part, would have an opposite prediction. Now, the authors interpret that episode as being driven by energy demand shocks, and I agree that demand shocks in general were really important to generate the switch in co-movement between stocks and bonds. But energy demand per se was just an outcome, okay? So I don't think, given limited pass-through of energy volatility onto other asset prices, onto other components of inflation and asset prices in that period, I don't think that energy demand per se was driving that co-movement switch. So we can interpret, in fact, the post-2000 experience with a direct asset that tells us what these risk premium are in the data. So what we faced in the post-2000 episode is little uncertainty about trend inflation, these very persistent shocks, and relatively more uncertainty about transitory shock, at least until recently. This is changing, okay? But at least until recently, the transitory shocks in the post-2000 samples were dominating. So you can see the direct pricing of these type of shocks when you look at an asset that gives you a direct exposure to them. And over the post-2000 sample, we have access to inflation swaps. So we can look at the term structure of inflation swaps to figure out the pricing, okay? So this is a 1-year inflation swap. This is a 10-year inflation swap. The red line is if you buy, it tells you how much inflation you pay, the inflation rate that you pay if you buy that swap. So if the red line is below the blue line is your physical expectation from a survey of what you expect inflation to be over your investment horizon. If the blue line is above the red line, it is telling you that positive exposure to short-run inflation shocks earns a risk premium. I will be compensated with a positive premium. That thing switches for the long-term inflation swap. Blue line, that is what you expect to get, is below what you pay, okay? This is exposure to a trend inflation shock, very long-run inflation, and it should be negative. I buy an asset that is hedging that exposure, so I am willing to pay for that. But of course, uncertainty around, about that shock in the sample period was very small. So we would expect this premium to be negative, but small. And this is exactly what is happening in the data. So I will conclude. I think this is important, insightful, interesting, and timely. And I think the main contribution of the paper is to estimate the magnitude of premium for bad inflation shocks. That estimate comes from the 70s. It's incredibly useful for us going forward, okay? I think the other interpretation and the model that provides this interpretation raises more questions than provides answers, and I don't think it's needed for a nice contribution.